Hello, and thank you all for joining us for this morning's IIF ESG webinar. We hope you're all staying healthy and safe. I'm SONJA GIBBS, Head of Sustainable Finance here at the IIF, and I'm delighted to be here with you today. Thanks for joining us. Our new IIF ESG webinar series is designed to promote understanding of the rapidly evolving landscape for ESG disclosure and help with alignment of efforts to measure and track climate finance. So we've been looking at key policy and regulatory initiatives, disclosure frameworks like the TCFD, SASB, GRI, methodologies for measuring climate risk and portfolio alignment. Joining us for today's discussion of climate scenario analysis and TCFD reporting is David LUNSFORD, who is co-founder of Carbon Delta, acquired by MSCI last year. And David is head of climate strategy and policy at the MSCI Climate Risk Center. I will open with a scene setting question for David, after which he'll tell us more about his organization's climate scenario methodology. After David's presentation, there'll be a Q&A session where you can submit questions via the chat box. We'll get to as many as we can, but we'll stick firmly to this half-hour call. Just a couple of quick housekeeping notes. I'd like to remind you our discussion is on the record and press is in attendance. We're recording it and it'll be posted on our website afterwards. If you're joining via video conference, you can see us, me and David. We can't see you and participants can't see each other. If you've got questions, please use the Q&A prompt button at the bottom of the screen, and we'll be answering questions during the last 5 or 10 minutes of the webinar. Please note that attendees who join by phone will only be able to listen and you won't be able to submit questions. So let's get started. David, delighted you could be with us. We could maybe just kick off with a preliminary question to set the scene here. What do you see as the biggest challenge for financial firms in implementing TCFD recommendations, especially around scenario analysis? Do we need a standardized approach? And is it enough just to be tracking your carbon footprint?
Thank you for having me in this conversation today. And I think that's a very good question. It's a complicated question. Your first point is about what should investors be doing to comply with TCFD recommendations. I think, well, what they should be doing is exploring the options out there. And frankly, one of the biggest challenges is that the TCFD recommendations were very ambitious in what they ask for financial institutions to do, which are to consider numerous scenarios, take a quantified approach to climate change, and treat climate change like it's an existential risk, which portfolio managers and risk analysts are already used to trying to capture. So they, I mean, what we've been doing for the past 5 to 10 years is looking at footprint. And a carbon footprint doesn't capture all of those recommendations. It doesn't fit the bill. I think it does help to increase the understanding of risk exposure, but it doesn't really quantify the risk specifically. And it also doesn't turn the risk into this investment metric such as costs and profits, which is effectively what the TCFD recommendations suggest to do. So, so I guess maybe my answer to those questions are using carbon footprints is a good first step. It's not exactly in line with the TCFD recommendations, but I don't think the TCFD recommendations say that you have to all of a sudden one day as an investor, open your eyes and just immediately embed climate risk. It's a process. It's a multi-year journey. And the most important thing for investors to do right now is, frankly, educate themselves about climate change and start to draw a roadmap. That's basically the biggest barrier. And that's where most financial institutions themselves sit today, is in a learning process, needing to get more information and map their future response.
Thank you. That's a very good way to set the scene. We understand you've got some slides to share with us. I think people are very much looking forward to that.
Of points relating to our state of affairs with regards to scenario analysis and TCFD reporting. And I think first what I will do is draw a bit of a picture about the landscape for integrating climate into financial institutions at the moment. And I think we're at a very important stage in this multi-year journey. And that is that after years of international debate and discussion about climate change, what is climate change, how important is it, how do we quantify it? I would say the scientific consensus is sound. The decision from most policymakers around the globe are pretty well decided. Obviously, there's some very important missing constituents, but those, let's say, the naysayers are quieted more and more. And I think it's very clear that even if there's not, we have the Paris Agreement. If the Paris Agreement isn't fully implemented soon, then nations and subnational entities are frankly going to move forward with climate change action anyways. And we've seen this in the grassroots movement, through the Future Friday for Future or Future Friday movement over the past year. And it's simply the ball's rolling. Nothing is going to stop it. But what I wanted to show with this first slide is that some of the important constituents out there are pictured here in this slide. Mark Carney, Boris Johnson, but frankly, the TCFD recommendations were really spearheaded by the duo of Mark Carney and Ma Jun from the Bank of China a few years ago. And Mark Carney is a real climate stalwart. He is really leading an international charge of central bank regulators to integrate climate change risk into investment reporting processes. And this is obviously, in 2016 and 2017, obviously the TCFD recommendations have gotten the ball rolling significantly, but Mark Carney is simply pushing this more and more forward as time goes on. And in my view, what Mr. Carney is doing is simply trying to facilitate the implementation of the Paris Agreement. That's because within the Paris Agreement is a very clear statement that there needs to be funds flowing from developed countries to developing countries in the sum of 100 billion US dollars per year over the course of the years 2020 to 2025. And from what I can see, this risk reporting will feed into a bigger reporting process in the UN process of implementing the Paris Agreement. So maybe in the next couple of years, we have enough reporting going on to understand how much is really being invested in flowing, like I said, from developed to developing countries. And if this finance is proven to be on the table and the financial flows are actually taking place, then the other big topic relating to the Paris Agreement will effectively be unlocked. And that is the topic around ambition. So when finance flows, countries are able and willing to put more ambition on the table. And that creates a virtuous cycle of climate action. So I feel that Mark Carney and what he's doing at the central bank level, and frankly, what he will do as the ambassador for private climate finance is really extraordinary. And it could result in the implementation of the Paris Agreement and the long-term feasibility of accomplishing aggressive climate change goals and setting those goals in the first place, of course. So let's hope that even though the COP26, which was scheduled to happen in November in Glasgow, let's keep our hopes up that it indeed happens in middle of 2021, and that this additional 6 months that we will probably have to participate and feed into that international process will, this slight delay will actually help move that process along, because again, the more we have proof that significant finance is flowing, ambition can actually be put on the table. So this would be great. And I think there is, without a doubt, a massive amount of activity with regards to regulators and particularly around central banks. I've just listed here on this slide the fact that there's the Network for Greening the Financial System, which consists of more than 50 different central banks. They are almost, not all of them, but many of them are looking into the mandatory implementation of climate risk disclosure for their regulated entities, of course. Some of the most active central banks I've listed here, of course, the Bank of England, France, the Netherlands, Australia, New Zealand, Denmark, and more. That NJFS is a process that is outside of the Bank for International Settlements, but they're effectively a coalition of the willing of the banks, of the central banks that are participants in the BIS. And of course, the more that coalition of the willing takes further steps, the more that the BIS itself will also move forward. And you also have European-focused regulatory entities also playing a role, like IOPA. And there's basically a lot of activities happening in the regulatory group, but also in this next slide, I just want to say there's also a lot of groups of institutional investors that are coming together this year and also trying to explore what does it mean to report climate risks, to disclose them, and to manage these climate risks over the long term. So you, of course, have the TCFD, which I consider a stakeholder group. You have the Net Zero Asset Owner Alliance, Science Based Target Initiative, Climate Action 100+. You have groups under the World Economic Forum, IIGCC, so on and so forth. And obviously, with these stakeholders in mind, you have trillions of dollars that are being managed, and obviously exploring, like I said, the use of different climate change data sets, climate risk disclosure processes. So the more of these stakeholders are able to report and use climate data, the more they will feed back into those regulators, and you'll have a good, solid understanding and let's say the foundation for much larger scale climate risk reporting globally. And I wanted to say that climate risk disclosure is not the only use case for climate risk data. There's a lot of use cases. They're all very important because they have to communicate together. There's a whole once something is reported, it's obviously managed and tried to reduce risk exposure. And you can see here in this slide, once an institution reports a value related to their portfolio's risk, obviously they're going to try to optimize that risk, manage it down over time. And that means that the same data sets that are reported upon effectively need to help in other processes internally, like security selection and stakeholder engagement with companies, so that companies know the risk that the portfolio managers or the institution is evaluating, and they have the option and ability to improve their risk assessment. So there's many use cases, of course, within those different use cases internally. Obviously, asset managers will start to build products. They'll start to use more climate data within the construction of indices or the different investment products which are climate focused. So I think over these next few years, we will see new entrants in terms of data providers in the market. We'll see new kinds of data sets coming into the fold, and we'll also see a lot of new and innovative investment products for institutional investors to help them manage and scale down that risk exposure. I also just want to go into, well, I'll mention here in the next slide that some of the data sets that we offer at MSCI, like the climate value at risk, also the warming potential, have all been used in different reporting processes thus far. You can see a few of the reports that we worked on with AXA and Aviva and several institutional investors under the UNEPFI framework. There's no, I think you can, I encourage anyone to explore and read through these reports. There is no one way of disclosing climate change risk. I think AXA and Aviva have been drawn towards our metric for specific reasons of their own. And like I said, there's other metrics out there that I think can empower the investors to report climate change risk and manage it down. But one particular metric that I want to mention that has been getting an increasing amount of interest over the past 6 months has been what we call warming potential, and that is the name of our metric at MSCI, but it's maybe more broadly known as a temperature alignment metric or an implied temperature rise metric. And effectively what this metric does is the data provider or the researcher analyzes a company and its activities and uses a methodology to determine how that company's activity will potentially drive temperature rise to a certain level. So each company has a alignment. You could call it a score, but it's really a temperature that their activities show that they are aligning with in the future. And so when you apply, if you hold the equities of that company or other securities issued by that company, you can take the company's alignment level and apply it to that portfolio of holdings. And obviously you come out with a degree alignment of that particular that portfolio when taking into account the warming potential or the alignment of the underlying issuer. So you could see here, we've done these alignment analyses on a number of different kinds of portfolios. And obviously, in order to achieve long-term climate goals, you want portfolios to be aligned with a 1.5 or a 2 degree temperature rise. And frankly, business as usual for global activity is almost 4 degrees at the moment. So you could understand that most portfolios are not aligned with a 2 degree temperature at this moment. Only the real portfolios that are only containing companies that either don't emit anything or are producing, let's say, very products which are really aligned with low carbon future. So with that being said, you could see that metric being highlighted in the AXA report. AXA here reported that the warming potential of their main corporate indices was roughly aligned with 3.3 degrees, and they've been when looking at their divestment portfolio and taking the temperature of that portfolio, our measurement was 4.6. So they've been shedding companies and divesting from companies which are aligned with very high temperature levels. And these bar charts, I don't need to go through them, but they delineate different AXA entities, and they align the temperature of some of their entities internally. And you can see also in the Aviva portfolio, the Aviva report, that they also use this warming potential of their portfolio metric. So Aviva reported that their equities portfolio is aligned with a 2.9 degrees. And so they obviously benchmark it against the previous year, as well as business as usual and market benchmarks. So you can see, I would just say that there are a lot of metrics out there for investors to use. This alignment metric has really gotten a lot of attention. I think it's interesting. It communicates very easily to readers of their reports, and I think it is also something that feasibly internally a institutional investor could set a temperature alignment, or let's say thresholds for temperature alignments for portfolio managers to invest in. And so, for example, a portfolio manager might be encouraged to invest in an oil and gas or a power company that is 2.5 degree aligned or less. And then they would have a selection of companies to choose from. And obviously, as let's say as more and more companies align their behavior with a 2 degree scenario, there's obviously more companies that our metric would show, meet those criteria, and the selection will increase. So I think maybe that just tells you a little bit about this warming potential metric. some of the regulatory landscape of what we're seeing. And I would like to open it up there for some Q&A.
Great. Thank you very much, David. That was absolutely fascinating. I think we need an hour to get through just the Q&A on this. So thank you very much. I will start off with a question that's come through and remind folks that there's a button on the bottom of your screen to ask questions if you'd like. So when you think about different sectors, how do they differ in terms of their exposure to physical and transition risk? And how do you use your tool, the information, for portfolio construction or tilting your portfolio?
Well, I guess it's quite clear that exposure to different types of risks really varies depending on the type of risk under question. So, of course, transition risk will much more significantly pertain to companies that have either a large exposure to scope 1 emissions, which are direct emissions, like a power company that has a flue for gases to come out of, and you can measure how much direct emissions they have. There's scope 2, which is, of course, energy use. And so there's big companies in, let's say, the material sector or industrial sectors, which use a lot of energy to input into the production of a material that they sell. And then, of course, there's companies that have large scope 3 emissions. I guess, one of those would be, you would think of emissions within either the upstream or downstream of the value chain of a company. You would think of maybe an oil and gas company, and the fact that most cars on the road are burning oil that has been purchased from one of those oil and gas companies. So that, there's companies that have emissions along any of those three scopes are obviously exposed to some kind of transition risk. And I think the most simple to understand is of course, the companies that really have direct emissions. And I think those are the main, let's say the main focus of any investment strategy should be to try and understand direct emitters and what you can do to encourage those direct emitters to reduce their emissions. Obviously, scope 2 is also important, but it's not typically regulated by. So there's very little regulation out there that says that you can't use electricity if you can pay the electricity bill. And obviously, I mean, you and I, some people watch their television more than others, and so just individuals have a bigger scope 2 emission level, and no one comes and tells you to turn off your light or don't watch television or do some other nighttime hobby as much as another person might do. And the same goes for scope 3 emissions. I mean, we live in a very interconnected world where supply chains are very complex. So at least in the way the world has been developing for the last 30 years, no one is going to immediately tell a company that they can or cannot use a particular supplier in another country. So the fact is that I don't mean to go into too long of a description, but different scopes, all scopes pertain to climate risk, transition risk, that is. Different scopes, I think, deserve a different amount of focus. Now, physical risk really don't, it's industry or sector agnostic. It's really location specific. So you really need to pay attention to any company and where they're placing their factories and their businesses, and what kind of physical risk they may be exposed to. I think it's worth noting that, of course, most of the big cities around the world are near coastlines. They have usually big ports, and frankly, they're either by a coastline or they're near a river and have access to some sort of river transportation. So flooding, some types of storm, heat, all of these are potential significantly increasing risk when it comes to physical assessments, and they all need to be taken into consideration when assessing a portfolio for physical climate risk. So, yeah, I'll stop there.
Okay. So this next question may get into the secrets of the temple, but the question is, how do you actually go about calculating the portfolio warming potential, if that can be explained in fairly straight, without a blackboard and chalk?
Well, I think it's I mean, it's the essence of the methodology is simple to understand. It's about understanding what a benchmark intensity for different sectors in different countries would need to be in order for all sectors in all countries to be in alignment with a 2-degree goal. So we evaluate these sectors and countries. We have benchmark intensities for each sector, and we measure how a company's activities, what distance is that company away from that benchmark intensity. And we have a methodology internally which looks at, well, the emissions themselves, but also we look at the innovative capacity of companies, the management capability of companies, and we use that to quantify the future intensity that a company is headed towards. And yeah, then we measure the distance again of that future intensity from the benchmark which it needs to be, and we come up with an alignment level for each company.
Thank you. No, I think that's quite clear. We are approaching the end of our time, but one last question here, which I think is very interesting. COVID-19 has brought much more focus on resilience as a key ESG variable. So how can investors get a clearer view of climate-related physical risks across the supply chain, and maybe thinking about some new forms of data generation, automated data, not relying on self-reporting?
I think that's a very good point. Supply chain information is extremely difficult to come by. And I think that we're only now at a stage of being able to estimate supply chain risk and let's say the risk exposure of transition risk. I'll focus a little bit on physical risk because I think that's what, that's really where the question has lied. So I think some supply chains for industries are quite clear. We know where, a vast majority for certain inputs for certain products come from. But mapping that, and especially mapping some complicated supply chains, like for example, agricultural sector, this I think will need to be done through I guess, satellite data or some other type of third-party independent data sets. I think, in my view, the best way to go about this is to really significantly understand physical risks first, where they're happening, where the risks are greatest, and then try to map an understanding of those physical risks to key hubs where products are being sent. And you can't always exactly know who's going to be the buyer of those ingredients or the product itself, but you can get a sense, a portion of the risk which may be passed through the supply chain. And I think that's where we're going to have to start, is not making too many assumptions, but just understanding aggregately as a whole where risks are and where they're going. And that's probably the first step for supply chain risk analysis from a physical risk point of view.
David, I'm so sorry that we've run to the end of our time. We'll have to have you back to continue. This is David Lunsford of MSCI Carbon Delta. Thank you all for joining us for this ESG webinar, and we'll be in touch with details of upcoming webinars. That's it from us. Have a great day.